So is it fair to say, would you say that you believe that the markets are continually changing?
Yes, and I think they look like they're not changing. If you have a random up and down movement, then it's going to look like a chart.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. Walter here, and Darren is on the line. Hello there, Darren.
Evening, Walter.
So we're going to talk about the entries and the exits. And this is something that it's kind of been niggling with me, and I'm hoping that this discussion will kind of open it up, because I know one of the unique things about the way that you trade and the way that you view the markets is that you see how it's likely that when you take a trade, whether it's a buy or sell, you have essentially a 50-50 chance of it working out. Now, obviously, that's going to differ depending on the exit strategy you use. So my question is, if we have a 50-50 likelihood of our trade working out for profit or for a loss, why is it then that our exits are not a 50-50 proposition? And I'd like for you to get into that, because I know that you put a lot of effort into your exits, Darren, and I just want to kind of dig into this, because I think this is a fascinating topic, especially for traders out there like myself who are trying basically to get the perfect entry and that sort of thing as part of our system. And I know that's not necessarily the crux of the way that you trade. So can you unpack that for me and sort of talk about why it is, or maybe it's not, why would the odds be different for an exit versus an entry?
Yeah, it's kind of really, it's more about having a different mindset about the odds of an entry and exit. The usual approach is people decide how they'd like to trade and what sort of entries they want to take, and then they want to find out the odds and probabilities that entry will give them the outcome they desire. And I kind of come at it from a different point of view, and really I'm saying, however you enter, because of the complexity and randomness and luck and all those other things and human error, you can't really put an odd, and you can't work out the odds for that entry and it hold true. So what I'm saying is, okay, let's say that the outcome of every entry is random. So essentially you're adopting the mindset that it's a 50-50 bet every time you trade. Okay, so I'm not sort of back testing and saying, right, the outcome will be 50%. I'm saying it's a coin toss. There's so much complexity and randomness that you can't know what the outcome's going to be. And even if you test a period that's past that you've traded, or just back testing, that figure doesn't really mean anything, because all it represents is what happened in the past. And minute differences in the future, even if the market conditions and players are the same, can give you a different outcome. So why try and spend your time getting a number to believe in if it's not going to hold water in the long run? I'm saying instead, accept that it's completely uncertain, that it's a coin toss, and then look in other areas to make your money. And for me, the big advantage in that is you cannot be disappointed in the outcome, because you've kind of accepted that it's completely uncertain, and then you focus on other areas of trading and your other techniques to make your money. And I think it's just a completely different mindset to how most people approach trading. What I'm always trying to do is say, essentially, when we break trading down, it's a simple matter of buying and selling, and hoping to make more on our winning trades than we do on our. Essentially, it's very simple. So if it's very hard for the majority of people to do that, then I'm saying, maybe it's the mindset that they're coming with, the techniques they're using to try and be profitable that are causing the problem.
Yeah, because there's so much focus on the entry, isn't there? I mean, usually what will happen look, this is what most traders do. I know I did this, is you would look at a system and kind of maybe not even backtest, maybe kind of eyeball the charts and go, yeah, it would have done, I think it would have worked. And then maybe you trade it for a while and, it doesn't seem to work very well, or you're in a drawdown or something. So then what you do is you kind of add more rules or more indicators or filters to the entry, because the thinking is, well, I'm just not getting in at the right spot on the chart here. Something wrong is here. And all that focus in the beginning as a newbie trader is on the entry. And what you're saying is really your focus should be on the exit. Is that fair to say?
Yes and no. And, really I'm saying just the whole way you think about trading and could possibly be wrong. You're coming at it with the wrong mindset to try and solve the problem. It's like that story about where they were trying to make like a jet, weren't they, for some food processing, and they got like all these amazing scientists in and computers, and they were trying to design the perfect jet, and they worked out what it needed to be, and so they produced these jets, and they never worked. And then in the end, what they did was they just started with like a simple nozzle, and they sprayed it through, and then they tweaked it, and if it improved, then they tweaked it a little bit more. So they just kind of went down a trial and error route rather than trying to be really scientific about it. And I just think in trading sometimes people are trying, looking in the wrong places to find the answers. And so I just sort of try and be contrarian. I say, right, well, this is what everyone's doing, and that doesn't really seem to be working. So, how about we kind of look at the opposite of what everyone's doing and come at it from a different point of view. And obviously, I'm really into this whole cognitive bias and how we make decisions thing. And, I can see if you kind of match that up to the beliefs that people have about trading, you can find a pretty reasonable explanation of why people do or prefer to trade in certain ways.
Yes, right. So I think one of the interesting things that's come up here today is this idea of the backtesting and how you can do this backtesting, you can get some numbers, and that sort of gives you perhaps maybe you would say a false sense of confidence. Is that fair to say?
I wouldn't say it's a false sense of confidence, because you've got to believe in how you're going to trade. What you need to do is accept that your drawdown might be more than it was in the backtesting. Your win rate might be lower or higher than it was in the backtesting. It only gives you a feel of how it should perform in certain market conditions. And then, how it really performs when you trade comes down to the judgment calls that you make along the way. And I think that you're better to make judgment calls after you have the sort of information of how your trade is working, rather than sort of trying to predetermine it based on what happened in the past. So, for instance, when we come to exit rules, it's why I think that having a fixed exit is probably not the best way to go, because you cannot react to the market then, and you're told that you have to follow your rules and stick to your system, whereas I think you're much better to look at it as a judgment call, and wait until you have the information of you've entered your trade, the market has moved, and now you can make a decision with some sort of context.
So is it fair to say, would you say that you believe that the markets are continually changing?
Yes, and I think they look like they're not changing. If you have a random up and down movement, then it's going to look like a chart. So although there are repeating patterns that appeal to us visually, that's more because of how we look at the charts than anything. For instance, we have the X scale, which shows time when we look at Forex chart, and we've got the price on the Y-axis. if you remove that, the time element, and just had the movement of price, then, you know, we wouldn't make all the assumptions we do about, but, you know, what's significant. You know, so like trend lines and support and resistance and patterns, candlestick patterns. I believe all of those are, although, you know, I'm not saying now that they cannot be used to trade profitably, but I'm saying that we perhaps overemphasize their importance because of the visual aspect of how we view the charts.
Yeah, I think that's interesting, because I've always thought the same thing about pivots. Because essentially what pivots are, pivot points are using the previous day to sort of set the stage for today. Essentially, that's how I see pivots. And I always thought that they're kind of funny. And I think that they can kind of make sense in some situations. But I guess it's easier for me to look at pivots that way than it is for me to look at candlestick patterns. But it is kind of the same idea, isn't it, what you're saying? Because if you just take away the x-axes, all you're seeing it's just up and down, right? That's all you're going to get if you're a one-dimensional chart. Exactly.
And then if you stretch that out over time, then it's going to make patterns that are visually appealing. And, you know, so if you go over a period of time on a chart and mark the candles that were the best entries into any particular trades you would have taken in that time, that's, you know, the optimum entries, and see if there's any, you know, distinctive pattern of all those best entries. Okay. And, you know, really, I think if I was going to use price action, I'd want to see those patterns at the majority of those key best entries. And I see just random. I see little candles, big candles, one with wicks, you know, some without wicks. There's no recurring pattern there. So, you know, why would I use that to enter my trades? Because I want to have the majority of my entries to be you know, the best possible entries. And you know, so if I'm going to do that, then, you know, I'd want price action to be at the majority of those points, and I don't see it.
Right, and that's a fair argument. I completely agree with that. However, what I would say then is you get the same result if you are looking at the charts and you're taking a sell trade every time the chart bends downward, and a buy trade every time the chart bends upward. Because every time the chart bends downward, it's not necessarily going to go down for 400 pips. And when it bends upward, it's not necessarily going to go up for 700 pips, right? It's the same result, isn't it?
It is, yeah. But the key difference is the psychology behind it. It's the mindset behind it. I know that the outcome of my trade is purely down to the movement of the market. So I'm not expecting to be right, and when I'm wrong, I'm not questioning my process and agonizing over whether I really should be changing my process and whether that's right or wrong. I'm just, you know, so I'm accepting the uncertainty more rather than trying to, you know, say, you know, I'm good at this, I know what I'm doing, and I'm going to be right. And then when I'm wrong, I go through that whole psychological issue, and that brings in more human error to my trading. And I think that, you know, in the long run, that's what causes most of the trouble for people.
Absolutely, yeah, that makes perfect sense. So now the question is, how do you avoid making those same mistakes when you look back with the hindsight bias at your exit decisions? Because you're taking away, you're letting yourself off the hook on the entries, but now we have to decide to take profit or hedge or do whatever, you know, whatever the decisions are in terms of getting out of these trades. So how do you guard against that in terms of your exits?
How do you guard? Well, you know, you're always going to feel bad about your exits. Is something that I picked up from Denise Shull. So whenever you exit, you're going to feel bad about it. So when it comes to exits, you know, I have, say, 2 or 3 options of what I can do when a certain event happens. Okay, so for me, the event will be price closing against the direction of my trade. So if I'm in a long trade and price closes down, then I'll have like a few options to manage my trade, like move my stop to break even, do nothing, or take profit. Just some sort of simple options. You know, I accept that I'm always going to feel bad because, for one, I haven't got out at the optimum because I've waited for a price to retrace. And 2, if I get out and price continues, I'm I'm also going to feel bad. And, the way I deal with it really is by looking at my long-term results and using that as the justification for how I'm trading. So if I only get 40% of a move because I picked the wrong exit, that's pretty bad. But if I'm up on my yearly target, then I'm achieving my goals anyway, so it doesn't matter. So I look at the long term, the bigger picture, to deal with the disappointment of the individual trades.
Sure, that makes sense.
And after a while, it becomes habit and second nature, and you kind of accept that the majority of your trades you could have picked a better exit. You just kind of have to accept that.
Yeah. So you might look at your exits the same way that I look at, say, a win rate. So, for example, you kind of have an average or kind of a goal. So let's say I did a bunch of testing on a system and I found out that it had a 55% win rate. So the win rate to me is kind of like what we call the median high tide line. So what's the average high tide line? Because that's really important if you're going to build a home near the water, because one, you don't want the house to get destroyed by the storms and the high tide, king tides and things like that. But the other thing is it kind of sets the stage for you. So if you say, look, I've done my back testing, it looks like this system's got a 55% win rate, and then you go in and start trading it, and week one you're in and it looks like it's got a 30% win rate. So what do? You start thinking, well, should I freak out here? Is it just the market's a little bit different? Is it unlucky that I came in at this point with this system? Because later on, maybe it'll get up to that 55% level or around that level. And I wonder if that's the same way that you look at your exits, because you say, look, I have this goal to make this amount from exiting my trades. And as long as I'm achieving that or coming really close to that, then I feel pretty good. It could be a little bit low tide, it could be a little bit high tide, it could be over my target, for the year at this stage, or I could be a little bit under it, but I'm hovering around that target, and that's a good spot to be. And so I wonder if that's the same way that you look at it. Like, for example, if you're 6 months into the year and if you've gone over your target, your PIP target for the first half of the year, you've gone over that 50% mark. Do you freak out because you think you're going to have a lot of losers in the last half of the year, or do you pat yourself on the back, or how do you view that?
Yeah, I just view it as being favorable market conditions, and I've just been lucky with my exit calls, and also there is this element of if you've spent a lot of time trading and watching charts, then you kind of develop this empathy for the market, and you develop a feel of when it's perhaps better to stay in or get out, and that's something that you can't really sort of measure. And I mean, I suppose you could struggle to prove whether it exists at all, but I kind of believe in that. Because we are trading against other humans, you can read the market, and I know I kind of always say, oh, that's not true, but I think you can in more of a sort of feel, looking at your emotions and feeling that empathy with how the market's moving. And I think a lot of people try to go down that with kind of a very scientific, reading individual candles and elements like that, and I think it's more of a intuitive thing that you pick up over time. Does that make sense?
Oh yeah, I think there's a lot to that, Darren. I agree. I think that you can get to a point where you get a feel for, and again, I don't know if there is any way to quantify this. I mean, I suppose you could look at sentiment or something like that, but I think there's a certain point where, as a beginning trader, you might look at a major fall on, let's say the euro falls a lot. One day it falls 500 pips. You might look at that and go, wow. As a beginning trader, you might think, you could think, wow, it's gonna come back to the middle of the Bollinger Band. I got to get ready to buy. Or you might think, as a beginning trader, wow, that's a strong trend. I better jump on it. But I think as an experienced trader, if you've seen a lot of charts, you kind of get this sense of whether or not this is a situation where the market feels like it's extended too far, and so there is going to be that normal sort of pullback, or whether it's just going to be kind of what they call the dead cat bounce, where it's just it's made a big move. Yeah, it might come back a little bit, but it's just gonna keep going. And any kind of a pullback is just another reason to sell. I believe in that. I think you can get to that point.
Yeah, I strongly believe in it as well. And it's kind of like a confidence thing. And I think that's the kind of confidence you want to develop rather than just the confidence that your backtesting gives you. And I think, I know I'm kind of always negative about backtesting, and I think it's a really important part of trading. But again, I think people give too much emphasis to that alone rather than looking, like we say, that sort of the feeling that you've built over time and experience. They did some research, and they found that traders that read fiction were higher performing traders because they were more in tune with being empathetic with other people, like the characters in the book. Have you heard that? Have you read that research?
No, I haven't heard of this. I haven't heard of that study. No,
I don't know where I got it from.
That's fascinating.
Yeah, I think it's Denise Charlogan. I mean, she always brings up interesting stuff. Yeah, and so really, it's the best strategy to have no strategy at all and just get up in the morning and see how you feel. And I think that probably is the best strategy. But knowing human biases and waking up feeling rough one day, I think you kind of need like some basic structure just to kind of keep you, just to sort of make those initial decisions a bit easier. But I think, really the best strategy for trading is no strategy at all.
Yeah, that's interesting. I mean, how would you, how do you interpret those data where it says, that finding where they say, yeah, if you read fiction, you're more likely to be a higher performing trader. To me, that's interesting because the data, the reports that I hear about just through the major news are things like the more psychopathic personalities end up being the better traders or whatever. So this it goes against that a little bit, but I think it makes sense because what I've noticed is that I believe one of the advantages that women have in general in trading is that they are more likely to be in tune with how they feel, and kind of like what you're saying about reading fiction. And so maybe that means that they're more on guard against doing something silly, taking that revenge trade or adding too much risk on this one because you had 3 losers last week or whatever it is. I think that women are more guarded, and men tend to be, I know I'm generalizing, but men tend to be more ego-driven and they want to be correct, whereas women are much better sort of in general, interpersonal relations and understanding kind of how they feel and seeing where they're at. And I think that there's a lot to be said for taking stock. Where am I at today? How am I feeling today? Am I going to execute as I should, or am I in a bad spot? Should I just walk away and take a day off and not trade today? These are the sorts of things I think that women are much better at doing, and possibly the type of trader that would be into, reading a lot of fiction. So I find that fascinating.
Yeah, I think that kind of mindset as well will reduce human error, and I think with a lot of trading, if you could just reduce the mistakes you make, the human errors, that can be over the long run be the difference between a strategy that's breaking even and one that's making steady gains every month. And I think that's perhaps an advantage that female personalities might have.
Absolutely, yeah. I mean, the big thing is, here's one thing you can do as a trader. And doing this one thing can completely change your bottom line, which is just don't take the big loss. I mean, don't let the big loss come and take that huge bite out of your profits. If you can do that one thing, and obviously that can come down to what you're talking about, which is being aware of where you're at, making sure that you're not, in that mindset where you're going to do something totally ridiculous and put your account at risk. So those are the sorts of things that people who are self-aware, they don't make those. They're not likely to make those mistakes. So that's interesting. I do think that backtesting, to me, I think backtesting is one of the great tools for traders. So I probably differ a little bit more on that side of things. And I know that you're saying, I know you're not totally throwing it out, but to me, even if you do your back testing and you say, I don't care that I got a 65% win rate, I don't care about any of that stuff. I'm not going to use that in my position sizing algorithm or whatever. You can throw all that away. Even if all that is useless data, I think the act of doing the trades and taking the trades and doing and being vigilant, I think that there's a lot in that that's valuable, which is just the practice basically.
Yeah, and I really, I am with you, Walter. I'm 100% think that backtesting is a brilliant tool, and I just think with a lot of things in trading, it's the mindset and how you use that data that is either going to make it a positive or negative for your trading. And so you just kind of have to see that data for what it is. It's the data for a specific period and specific market conditions. So, it can give you a good idea in those conditions of how your strategy will play out and how profitable it'll be. But at the same time, you have to you have to take on board that, that might not be the case in the future. The uncertainty remains.
Yeah, that's right. That's interesting. So to me, that sort of highlights your thinking in this sense, because what you're saying is that the backtesting can be really, really valuable. It can be very helpful. It can be a tool that you can use to build your confidence. But at the same time, the markets are always changing and we don't know what's going to happen in the future. That's sort of the standard disclaimer, right? Past results are not indicative of future results. And that makes sense. But I think my point would be, if you as a trader believe that the markets have done what they've always done and they will do what they always will do, and it's sort of that, it goes through cycles of gets really quiet, gets really volatile, goes up, goes down, goes in a range, those sorts of things. If you believe that to be the case, that really, the markets aren't as dynamic and they're sort of cyclical, or in some ways always what they've been, then maybe you would be more likely to ascribe more value to your backtesting data. And if you are, I suppose, more on the side of where you're at, which is basically the markets are changing, they're very dynamic, then you have to be on guard that what you have in your data pile there from your backtesting may not map onto what happens in the future. Is that a fair characterization? Or
yeah, and also, the unexpected happens more often than we think it does.
No doubt. Yeah.
It happens a lot more often than we think it does. And again, it's just about how you react when you then go to trade live and your results are not in line with the backtest data and the conclusions you draw from that. Okay, and the conclusions should be that it's quite normal for your data to vary over short periods of time, and then you need to kind of look at why there's been that variance, and then either make a change to how you're managing your risk or your positions, or not, and accept that you need to give it a bit more time. It's all about that mindset and whether you think that you can somehow control the outcome, or whether you're going to just accept it to be wholly uncertain, but at the same time feel that you have some sort of edge in your technique.
Yep. Yeah, that's well said. I like that. Yeah, that's good. Yeah. So one last question before we shut this episode down, because I have to know what you think on this, because when you take a system and you apply a strategy for exiting that system. So for example, let's take an example. So concrete example. So let's say I have a system where I flip a coin. And in system A, I flip a coin, heads I buy, tails I sell, and I'm just going to try and get 25 pips, okay? All right, so then I've got another system, and my stop loss might be 30 pips, 35 pips away or something like that. So I'm trying to take these quick profits relative to my stop. And another system, I flip a coin, I go heads, I buy, tails I sell, and in this case, I've got 100 pip stop loss, and I'm trying to get 500 pips out of my trades. What would you say to that? I mean, would you expect different win rates, or how would you do with that? Because I guess what I'm saying is it's a long-winded way of asking, how does your exit strategy influence your win rate?
I think the longer you stay in the trade will influence your win rate, and the further your exit point is from your entry, the stop loss and the take profit will affect your win rate.
Yeah, exactly.
Definitely. And
yeah, so essentially, if you have a really tight stop, that's going to affect your win rate, and if you have a really tight target, a really close target, that's going to affect your win rate, right?
Yeah, exactly. And that doesn't mean that sometimes that may be reversed if you get the particular market conditions, but the longer you stay in the trade, the more opportunity there is for that trade to turn around and hit your stop, and the more opportunity there is for that trade to go to a bigger target, and that's kind of logical.
Yeah, so by having a stop loss further away from your entry price, you're giving the trade more opportunity to keep moving toward your target or to make money for you, I guess.
Yeah, because in effect you don't really have to time the entry then, because you could be getting in early, and you give price room to go against you before it goes to your target or in your direction.
Yeah, and the extreme example of that would be a hedge fund that uses essentially fundamental analysis to make their trading decisions and is not really technical in any sense. So in that case, these funds are taking trades and they're not really trying to time their entries at all. They're more interested in making sure that they don't affect the market by placing all of their orders at the same time. So they kind of scale in and scale out, but it's not really about timing at all. It's more about just, well, this is what we think is going to happen, and so we're going to get in the trade. And so that's kind of the extreme example of that. And and then it's sort of, in the end, it's either they were right, they made money, or they were wrong, and at some point they hit the uncle point and they have to say, okay, we were wrong, we have to pull out what money is left or whatever. So it's kind of it's almost like they don't have a stop loss or they don't have an entry strategy. It's just they have a general idea that this market's going to go down or this market's going to go up, and we put our money in and we sit around and we wait.
Yeah, because it's essentially the new information coming into the market that makes the market move and decides where it goes, and the assumption of what that information is going to be as well, not just the actual information. If everyone thinks that the Fed are going to put up interest rates, then it's not a surprise to see the dollar appreciating. Maybe that is, really the best way to trade. But again, you're still trading on what the other traders think and believe, and then there's going to be people that try and speculate off knowing what you're going to do. So if everyone's trying to buy the dollar, then people are going to be looking to be contrarian to that and suck people in going short. But it's not really my thing, and it's why I stay away from it. I'm not very good at fundamental analysis, and I haven't really got the patience for it either. But it's something that's overlooked by a lot of traders for whatever reason, and for me it's as valid as using technical analysis.
Yeah, to me it just makes it easier to have general rules, I suppose. I suppose you could still have general rules with your trading if you wanted, based on fundamentals. If a currency if they're raising interest rates for so many or whatever, I mean, or if the jobs reports have been trending up or down or whatever, I'm sure you could do something like that if you really wanted to make it sort of a rules-based system. But yeah, I think you're right. The big news, to me, the big takeaway with fundamentals is what happens in regard to what was expected, basically. So when the market is surprised, that's when things really get shuffled around a bit. And when the market isn't surprised and everything sort of shakes out the way it was expected, that's when things are sort of at the status quo and they keep going up or they keep going down or whatever they were doing before. But yeah, the surprise is the one that really kind of kicks them in the pants and changes the direction or whatever. So yeah. Well, Darren, I don't know. Do you have anything else to add about entries and exits? I know we've touched on different aspects of this, but I think this has been a really interesting conversation, and I'm looking forward to our next one. Do you have anything that you want to leave the listeners with?
No, just like always, examine your mindset and just question your beliefs, and perhaps just try and see things from a different point of view. Don't necessarily change what you're doing, but just consider it.
Yep, that's good advice. Can't wait to sit down next time, and we will talk about system execution. So that should be interesting.
Cool. Cheers, Walter.